Hello everyone, welcome back to the new class. Today we are discussing about analysis of financial statements. Analysis of financial statement or financial statement analysis. What is this analysis of financial statement or financial statement analysis? We know that what is financial statements and which are the financial statements. Financial statements are the statements which are prepared at the end of a financial period or accounting period to state the financial position of the business and trading result of the business. The statement which is prepared to show the financial position of the business is the balance sheet, and the statement which is prepared to show the trading result of the business is known as profit and loss account. So these are the two financial statements, profit and loss account and balance sheet. Here the analysis of financial statements means the analysis of the profit and loss account and balance sheet. What is there to analyze in that? Some figures are there. So analysis of the various figures shown in the balance sheet or profit and loss account of a business organization is called financial statement analysis. So we can state that a study of the relationship among various financial values as set out in the financial statements are called as financial statement analysis. What it is? A study of the relationship among various financial values. In financial statements, there are various financial values. A study of the relationship of all these financial values in a financial statement can be called as financial statement analysis. For example, we are comparing the balance sheet of 2 years, 2019 and 2020. In that there is an item, that is debtors, sundry debtors. In the last year, 2019, sundry debtors was there for 5 lakh rupees. Now it became 5,70,000 rupees. So this we can analyze. That 5 lakh to 5,70,000. 70,000 increase has happened in the case of sundry debtors. So what are the reasons behind it? That is an analysis of financial statements. Or we can compare all the total of current assets with the total of current liabilities of the same balance sheet. Total of current assets and total of current liabilities. And can find out that how much a percentage of current asset is covered with current liabilities. So that is a type of analysis. So in that way, a study of the relationship among various financial values which are given in the financial statement, which are there in the financial statements, are called financial statement analysis. That means financial statements analysis is a study of the relationship among various financial values which are there in the financial statements. And for that financial analysis, which are the commonly used tools? In order to analyze something, we should have some tools. So which are the tools used for analyzing the financial statements? So let us see that which are the tools. Tools of financial statement analysis. Which are the tools of financial statements analysis? See, here we can study about some of the tools. First one is comparative statements. Comparative statements. Second one, common size statements. Then the third one can be ratio analysis. Then fourth one, cash flow statements. So the tools are comparative statements, common size statements, ratio analysis and cash flow statements. These are the 4 statements which we will be studying as the tools of financial statement analysis in our classes. Various other tools are there, like fund flow statements are there, then trend analysis is there. So like that various tools are there. Out of that we will be discussing about all these 4 different tools. Okay, these 4 different tools will be discussing in our coming classes. Today we will be discussing one of the tool, that is comparative statements. Okay, before discussing that, let us see which are the significance of financial analysis. Significance of financial analysis. Significance of financial statement analysis. What are the significance or importance or objectives of analyzing the financial statements? What are the purpose for analyzing the financial statement? Various purposes are there. One of them is analyzing the earning capacity or profitability of the business. Analyzing earning capacity or profitability of the business. Analyzing the earning capacity of the business or profitability of the business. So how can we analyze the earning capacity of the business? We can analyze past few years income statement or profit and loss account. Say, if we analyze last 3 years profit and loss account, we can see that what is the trend of profit, whether it is increasing or decreasing. If it is increasing, there is chance that next year there may be chance of increasing the profit. There may be a chance of increasing the profit. So if it is decreasing, we have to do something to get a good profitability. Okay, so analyzing the earning capacity or profitability of the business is one of the objective, and another one we can say that analyzing the managerial efficiency. Analyzing the managerial efficiency. Analyzing the managerial efficiency of the business to check that whether the management is efficient, the management is working efficiently or not. How we can check the efficiency of the management? If the management is able to control unnecessary expenses or wastage, that management is efficient. So that we can check the balance, we can come back to the statement of profit and loss again. If the trend of expense, instead of increasing, if it decreases or maintains almost in the stable manner, we can say that there is efficient control system or efficient management. So in order to check that business is efficient or the management of the business is efficient, we have to analyze the financial statement. That means if we analyze the financial statement, we can come to know that management of the business is efficient or not. Okay. Then next we can say that analyze the solvency of the business. Solvency of the business. Analyze the solvency of the business, that is short term or short term and long term. That means analyze the short term solvency and long term solvency of the business. Solvency means strength, capacity to withstand. How much the business is solvent or capable to withstand for a short period of time. That means how much strength is there to pay off its short-term obligations. That is solvency, short-term solvency. How much business is able to pay off the short-term obligations? In order to pay off the short-term obligation, business should have some current assets or working capital. So how much working capital is there? That determines whether the business is short-term solvent or not. The capacity to pay off the short-term liabilities or not. And to check that whether the business is having long-term solvency. That means how much long-term funds are there with the business to meet its long-term obligations. Okay. So, if we analyze the financial statements, for that we can study about ratio analysis. We will discuss there that if we analyze the financial statements, we can come to know that whether the business is able to pay off its short-term obligations and whether the business is able to pay off its long-term obligations with the available money. Okay, so that is another important thing to find out that whether the business is solvent for long-term or short-term. And another one is inter-firm comparison. Inter-firm comparison. Financial analysis helps for inter-firm comparison of the business. That means we can compare the performance of our business with the performance of similar type of other business organizations. Okay, that is called the inter-firm comparison of two or more businesses. So if we compare the financial performance of our business with any other business organization of similar nature, we can come to know that the weakness or strength of the both organizations. Whether our organization is better performing than the other organization or not, and which are the strength or weakness of both of these organizations. That can be identified with the help of inter-firm comparison. Okay. Then next one is it helps for the forecasting and preparation of budgets. Forecasting and preparing budgets. Financial statement analysis helps to forecast for the future. Forecast for the future. For example, we are analyzing the trend for past 2 years or 3 years. Let us consider past 2 years. We are analyzing the financial statements. Say, statement of profit and loss we are analyzing. In that we will be having the income. Income trend will be there. How much was there in the previous year? How much is there in the current year? So if we compare like that, we can assume that in the next year we may get this much income. For example, last year the total income was 1 crore 20 lakh. 1 crore 20 lakh. This year it has increased to 1 crore 70 lakh. So next year there is chance of increasing the income to 2 crore because for the last few years onwards the income is increasing. Isn't it? So like that, expenses, if we consider the expenses, last year the expense or the production expenses was around 25 lakh. 25 lakh. And this year it has increased to 27 lakh. So next year there may be an increase of production expense to 2 more lakh. That means from 27 lakh it may increase to 29 lakh. Isn't it? So like that we can compare. So we can forecast what will be the income or expense in the coming years. And it will help for the preparation of budget also. We can use financial analysis for preparing the budget for next year. We know that what is a budget? It is a statement or quantitative statement of anticipated events. That means if it is a cash budget, that means that in the coming period of time, maybe for next 1 month, so that means the cash budget for the next month will be showing that next month which are the areas of receipts and what will be the amount of receipts and what will be the amount of payments. Isn't it? So like that, it will help for preparation of budget and forecasting for future use. So that's all regarding significance of financial statement analysis. Now let us see that who are the parties interested in financial statement analysis. Who are the parties interested in financial statement analysis? So parties interested in financial statement analysis. For whom it is prepared or financial statements are analyzed. First one is management. Why it is prepared for the management? By management uses? Because majority of the analysis are done by the management. Why? To show that the earning capacity of the business. Management has to identify that what is the earning capacity of the business. Then analyze the managerial efficiency. To analyze the managerial efficiency, management needs to understand that how far they are efficient. Then short-term solvency of the business or long-term solvency of the business. All those things for identifying or understanding. All those things business needs to prepare or business management needs to analyze financial position of the business. Okay. Then next category is employees and trade unions. Employees and trade unions. Employees as well as trade union analyze the statement, financial statement. Why employees needs to analyze? Because they have to know that what is the profitability of the business, so that they can claim for some benefits like salary hike or bonus or festival allowances, etc. For that, employees and trade unions will analyze the financial performance of the business. That's why they can claim for increase in the wages or salaries, and they can claim for bonus. They can claim for more festival allowances. Okay. The next category we can say that shareholders. Why they have to analyze financial statements? They have to analyze the financial statements to find out what is the earning per share. Earning per share means what is the profit each shareholders will be getting for their shares. What is the profit or percentage of profit for each share? So, in order to calculate that, we will make a ratio, that is earning per share. With the ratio analysis, we will calculate it. So, how much benefit a shareholder will get from a share? That can be identified with the help of ratio analysis. So, shareholders also will look into the financial statements, and they also will be interested to analyze that. Then another category is potential investors. Potential investors. Who are potential investors? The investors who are interested to invest in shares, or the investors who are waiting to invest in shares are called potential investors. They are ready to invest in shares. So, potential investors also will be interested, because they have to know that same way we have told related to shareholders, same way they also will be interested that to know that what is the profitability of the business, what is the long-term solvency of the business. Thereby, if they invest in shares, how much benefit they will get. So, in order to check all these things, potential investors also will be interested to check the financial statements of the company. Another category is suppliers or creditors. suppliers and creditors. Why suppliers and creditors need to check that? Because they have to know that they are the people who have already given raw material on credit. They have given the credit services to the business. Goods are given on credit to them. Then they should know that they have to know that whether the firm is able to pay back their liabilities, their money in time. And they also should know that, they also want to know that whether we need to give or whether we can give them further credit. When we can give the further credit, then they are able to return the money. So the ability to return the money should be found out. Okay, so suppliers and creditors will check into the financial statements. Then, like that, other category is bankers and financial institutions. Banks and other financial institutions. So they also will check in the same manner that whether the firm is able to pay back the loans taken from financial institutions or banks. And if they approach for further credit, whether it is possible to allow them credit. That means whether they will be able to pay back the money. That means whether they are credit worthy or not. Credit worthy means ability to pay back the obligations. So banks and other lenders will check. Then another category we can say that researchers. That means research scholars or students. Those who are studying about the financial matters of the business, financial conditions of the business. They also will be eagerly looking after the financial performance of the business. So they also will be interested to analyze the financial statements of the business. And of course, the next one is customers. Why customers needs to see the financial performance? Because customers needs to see the long-term solvency and profitability of the business. Suppose you are going to buy an electronic item, a washing machine or a television from a company. Then you have to check that whether this television or washing machine is advertised that they will be giving 5 years warranty. 5 years warranty or guarantee is assured. So in order to give the 5 years warranty or guarantee, the company should be there in function for the next 5 years. That we have to check whether the company having profitability or long-term solvency is there to exist in the business for the next coming 5 years, so that we can acquire the warranty promised in the advertisement. So while purchasing a product from a business for a long-term use, customers also will be interested to check. And another one is that the business who are having good financial position or profitability will be a business which are providing a quality product or service. So if business is having good profitability, it means that the service of the business or the goods produced and marketed by the business are good standard, a standard product. So these are the various parties who are interested in analyzing the financial statements. Now let us discuss the another topic, which are the limitations of financial statement analysis. Limitations of financial statement analysis. Limitations of financial statement analysis. Which are the limitations of financial statement analysis? We have discussed that financial statements are having a lot of benefits or advantages of significance. Now, any problem or any limitations or drawbacks are there for the analyzing financial statements or financial statement analysis. There are certain issues or drawbacks we will discuss one by one. The first one is it's a historical analysis. or we can say that it is post-mortem analysis. That means it's an analysis of what is already happened. What is already happened will not have an influence in future happiness. What is already happened may not be influenced for the future happiness, or it may not be repeated. So, accounting itself, we have studied that the major limitation of accounting is that it is a historical analysis or post-mortem analysis. That means analysis of what is already happened that may not reflect in future condition. So that is another important thing. And next thing is that the price level changes are ignored here. Ignore price level changes. Price level changes ignores the price level changes. What is this price level changes? We know that the money value decreases year after year. Money value decreases year after year. The 10,000 rupees spent today may not be equal to the 10,000 rupees spent 5 years before. Isn't it? So the value of money in these 2 years will be different. The value of money in these 2 years will be entirely different. So that is not considering here. That means we have told that we are analyzing the financial statements of last 2 years. So last year or previous years of the last year, some money we spent. We have spent 1 lakh rupees for production expenses. Last year we have spent 1,30,000 rupees. So we will calculate that 30,000 rupees extra we spent. But we are not considering that how much the value of money is decreased from the last year to current year. That is another important drawback of financial statement analysis. We are unable to find out how much value decreased in the in money, or how much money value decreases. Then another one is ignores qualitative aspects. Ignore qualitative aspects. We consider only the figures, they are quantitative in nature. We have told that the efficiency of management can be ascertained. Efficiency of management cannot be fully ascertained with the help of financial analysis, because we are analyzing only the quantitative aspects. The decision making capacity of the business, the intellectual capacity of the management or managers, and the loyalty of the employees working in the business organization, etc., cannot be ascertained with the help of financial analysis, because these things are qualitative in nature, and we can analyze only the quantitative things in financial statement analysis, because accounting considers only the quantitative aspects. Okay. Then next one is it suffers from the limitations of financial statements. It suffers from the limitations of financial statements. That means there are a lot of limitations in preparing financial statements. So that also will be reflected in analyzing the financial statements. Because we can say that if some errors, unidentified errors has happened in financial statements, in the preparation of financial statements, that will be reflected in the same manner by analyzing the financial statements. Okay. Then next we can say that not free from bias. Financial statements analyzed may not be free from bias because it will be done by several persons. Their personal judgments will also be reflected in the financial statements. So it is not free from bias, and we can say that it is also affected by window dressing. Window dressing, we know that it is showing a projected amount of profit or projected benefit in financial statements. So that method of manipulation in financial statement is window dressing. That will affect the financial statement also. If a window dressed financial statement is analyzing, the effect of window dressing will be there in the financial statements also. And another important thing is variation in accounting policies. Variation in accounting policies. There are variations in accounting policies. That means accounting policies, suppose we are analyzing financial statements of two business organizations, two different business organizations. If it is like that, the financial policies followed by two different organizations may be different. For example, simple example is that depreciation. If we have followed straight line method of providing depreciation and another business followed diminishing balance method of providing depreciation. So in that case, I will reflect that difference may be affected by the analysis. Analyzing financial statement may be suffering the problems of different accounting policies. So these are the various limitations of financial statements, and now let us discuss the next. That means the first important tool of financial statement analysis, that is comparative financial statements. Comparative financial statements. Comparative financial statements. So comparative financial statements are the statements which are prepared to compare the financial statements of two different years of the same business organization. Okay, or we can compare financial statements of two business organizations. That means with the help of comparative financial statements, we can compare either the financial statements of two different years of the same business organization or two financial statements of two different business organizations. So this is a horizontal comparison tool or horizontal financial analysis tool. Horizontal in the sense we are comparing two different years of business financial statements. And this will help for intra-firm comparison. Intra-firm comparison means comparison within the business organization. That means we are comparing the financial statements, two years financial statements of the same business organization. So there are two types of comparative statements. They are comparative balance sheets and comparative income statement. So these are the two different comparative statements. That means comparative balance sheet and comparative income statement. So first of all, we are going to discuss about comparative balance sheet. And let us see what is the format of comparative balance sheet. So this is, first we will be preparing the comparative balance sheet. Comparative balance sheet means we will be studying of two different balance sheets or balance sheet of two different accounting periods. So how to prepare a comparative balance sheet? What should be the format of a comparative balance sheet? That is what we are going to discuss here. So let us discuss the format of a comparative balance sheet. Okay. This is the format of comparative balance sheet. So let us see what it is. This is the format is same like a balance sheet. Since it is a balance sheet, you have to write the particulars column exactly like the format of balance sheet which we have studied in the previous class. You can see that video also. So like that you can write the exact format of balance sheet. That is the particulars column. Then note number, previous year amount, then current year amount. Previous year amount means if you are comparing with the 2019 and 20, balance sheet of 2019 will be previous year, current year will be 2020. Then absolute change between previous year and current year. So in order to find the absolute change, current year will be compared with the previous year. Okay, so that's what we have to written B minus A is equal to C. And percentage change. So what we have got in C will be compared with the base year, that is previous year, into 100. That will be the percentage. So all the columns will be horizontally compared and find out the percentage. That is what we are going to do here. Okay. And here is our question. The balance sheet of X Limited is given for the year 2019 and 2020. Equity and liabilities given here, shareholders fund. In that share capital given, equity share capital 18 lakh for 2020 and previous year it was 12 lakh. 18 lakh and 12 lakh. And non-current liabilities in that long-term borrowings, their debentures are given 6 lakh each. There is no change for 2020 and 2019. And current liabilities for 2020 6 lakh, 2019 3 lakh. Then let us come to the asset side. Their fixed asset, tangible fixed asset is there 18 lakh and previous year 15 lakh. So the last column here it is for the previous year and this is for the current year. Then current assets, in that trade receivables. Trade receivables we have 10 lakh and 5 lakh. And cash equivalent 2 lakh and 1 lakh. And we are going to compare these two balance sheets. So previous year, what is the previous year? Previous year and current year we can mark here. Previous year is 31/3/2019. Current year is 31/3/2020. So this is the amount column for both the years. So here in this format itself we are going to write. First item, equity share capital, equity share capital. Here due to place shortage, I have not written all the items. I have told that it is to be written in the format of a balance sheet. So all the items which are there in the subheadings also must be written. Okay. Due to price constraints, I have omitted some of the items. So anyway, we can write the next item, share capital. Under that share capital, equity share capital for 2019 it is 12 lakh. For 2020 it is 18 lakh. Now what we have to do? We have to find out the difference. 18 lakh minus 12 lakh, 6 lakh. 6 lakh is the difference. Then we have to find out the percentage. How to find out the percentage? 6 lakh divided by current year 12 lakh into 100. That's what C by A into 100. This is C by A into 100. So we will get 50%. So 50% is the percentage. Okay. Next item, what is there? Long-term borrowings in that debentures. We have non-current liabilities. In non-current liabilities, we can write secured loans. secured loans, then 8% debentures. 8% debentures how much? 6 lakh each. 6 lakh for the previous year. Current year also 6 lakh. So there is no change and there is no percentage. Percentage change also not there. The next item, current liabilities. In current liabilities, the item here is trade receivables. Trade receivables. Trade receivables we have here 6 lakh and 3 lakh. This year, previous year is 3 lakh and this year 6 lakh. So total change 3 lakh and percentage change 3 lakh divided by 3 lakh into 100, that is we will get 100%. Okay, so that is all regarding what percentage change, trade receivables. So next let us add the things. We can add the column. We will get here total 21 lakh for the previous year. 21 lakh. Here next column we will get 30 lakh. So what is the change? 30 lakh minus 21 lakh. 9 lakh we will get. Then what is the percentage change? 9 lakh divided by 21 lakh into 100. 42.86%. 42.86%. Okay. So next let us see the assets. Fixed assets, non-current assets. In that non-current asset, what is the next? Fixed asset, tangible. Fixed asset, tangible. Tangible asset is there. How much? Previous year, how much? 15 lakh. Here it is 18 lakh. There is an increase of 3 lakh. See, there is an increase of 3 lakh. If here 15 lakh and base year if it is 18 lakh, we will write minus 3 lakh. If there is an decrease, minus amount will be shown and the percentage also we get in minus. Okay, so 3 lakh divided by 15 lakh into 100. So it is 20%. Okay, then current assets. Current assets, which are the current assets given? Trade receivables. Trade receivables we have given 10 lakh and 5 lakh and 10 lakh. There is an increase of 5 lakh. 5 lakh divided by 5 lakh into 100. So how much we will get? 100%. Then after trade receivables, next item cash and cash equivalent. Cash and cash equivalent. How much? 1 lakh, then 2 lakh. Difference 100%. Difference is absolute difference 1 lakh. 1 lakh divided by 1 lakh into 100%. So here we will get the total. We can total here. So 21 lakh, 30 lakh, 9 lakh. 9 lakh divided by 21 lakh into 100, 42.86. So this is the preparation of comparative balance sheets. So comparative balance sheet will be prepared like this. Next is there for comparative income statements. Comparative income statements we will discuss in the next class. So this we are going to wind up here, and in the next class we will be continuing with comparative income statements. Okay, thank you.